Hello, welcome to our Lending Insights podcast. I'm Michael Morley of State Street Global Marketing. I'm joined by Kevin McGarr, Relationship Manager in our Securities Finance Division. We're here today to shed some light on how the securities lending market works and highlight some recent trends. To start, Kevin, can you provide some background on securities lending? Why do market participants borrow securities?
Yes, sure. One of the main reasons that people borrow securities is to short sell. And so short selling is when you sell high and then buy low. So you're betting on a security to drop in price. So that's one of the majors, but there's also some others that come with that. There's market making purposes, financing, arbitrage, either be a corporate, and in the past we've seen dividend arbitrage. And then there's something that's even more simple, and it just comes to sell-fail coverage or for settlement purposes. So securities lending really promotes efficiency, liquidity, and timely settlement within the market.
My next question touches on that last point a little bit as far as sort of benefits to the market in general that borrowing securities creates. How would you describe some of those benefits to the market at large?
Sure. Previously, you used to be able to short sell, and it used to be called naked short selling. So you didn't actually have to physically hold the shares before you sold them short. But that was actually banned. So with securities lending, what we're able to do is we're able to assist in facilitation of those short sells where they can borrow security so that they can sell it and also buy it back. But for settlement purposes, they could deliver on that particular security that they sold. And really with short selling, it's not just about finding a security that is going to go down in price, but it also helps with price discovery. And the reason why I say that is what we've found that when short selling has been banned in certain markets, and we saw this in 2008, 2009, bid-ask spreads really widened out. And when that happened, we saw less liquidity in the market, which also drove prices one way or the other. And the reality of it is with lending, what it really does is it narrows the bid ask. It makes price discovery a lot easier. And it also helps just facilitate those trades from settling. And so, that's truly the benefit.
All right. That's a pretty long list there. Fair enough. So how about the benefits to the lender? What does State Street's lending clients get out of participating in this kind of program?
The one big benefit that we really see is we're adding alpha to securities that are held long. And we have, I look at our clients in two buckets. I look at them from an asset owner's perspective. So we're looking at them from pensions, foundations, endowments, and sovereigns, and also looking at asset managers. So, your traditional 40 Act fund or mutual fund, or globally, you could look at them that way too. And really, you have to dissect them. You have to separate the two. From an asset manager perspective, one of the benefits that we've seen is we've seen a lot of index funds. One differentiating factor can be lending, where if you have a lot of fund managers following the same indice, one additional way that you could add alpha or return to a portfolio is through securities lending. It could be a matter of a few basis points, which could really change the way asset owner looks to invest in your program or into that platform. And it can be a differentiating factor when making an investment decision. So that's one part of the asset manager. But then there's another part that has more recently come into play. Asset managers are now looking at minimizing expenses. And the reason why they're looking at minimizing expenses, especially in the United States, is because consultants are more honing on expense ratios than returns of the portfolio. So, and this has been mentioned in numerous meetings with CIOs, and they're looking for different ways to lower their expense ratios. And one way to do that is through securities lending, where they can lower their custody fees by offsetting them with revenue that is paid back to the bank through securities lending revenue, which helps also when consultants are really looking and making recommendations based on expense ratios. Our ability to help asset managers lower those has been beneficial to them. And what we've seen of the top 25 asset managers within the US, 24 of them now are lending in some fashion. Now, from an asset owner perspective, they're looking to add revenue to the plan. They're looking to add revenue to the beneficiaries. And what we've seen is from asset owners, they have, through the crisis, through 2008, 2009, they've continued to lend. Some have sat on the sidelines. One particular group that has sat on the sidelines, but we've seen, really coming back and looking and evaluating programs is the corporate ERISA plan. So the defined benefit and defined contribution plan. They've been evaluating lending over the past couple of years, and we're actually now starting to see them come back in. And they're taking a more conservative approach, but they are coming back and they're finding ways to add additional revenue to the beneficiaries. So in summary, really what it is it's a way for our clients to generate additional alpha. It's a way for them to find ways to lower their expenses and provide benefits to the underlying owner.
Okay, so it can be beneficial in more ways than one, and really depends on who you are, I guess, how you look at it. So when you think about securities finance and how it's changed over the last decade or so, what stands out to you?
Over the past decade, I'd really say that what I've seen be the biggest change is cash and non-cash collateral and the way that borrowers are managing their capital. And the reason I say that is that there's been a lot of regulation that has come into play that has affected both cash and non-cash collateral.
Interesting. Can you tell me a little bit more about that? What is the role of cash collateral in securities lending?
Sure. So cash collateral, ultimately, when you look at securities lending, it's an over collateralized transaction where a borrower comes in and borrows a security, and they over collateralize with either cash and non-cash. So we're going to focus on cash with your question. So ultimately, what they do is, if we look at a very simple transaction, if they borrow one security and that is trading at $100, they'll provide us $102 of collateral. That $102 of collateral gets invested into a cash collateral pool, which is then invested in short-term assets. And prior to the crisis, those pools were significant in size. And what we saw stem out of the crisis is that there was some risk in portfolios because of the underlying assets that were held. And what we found and what you saw during 2008, 2009, where securities lending was in the headlines, it wasn't the risk of the borrowers or being able to, the indemnity of an agency lending program that made the headlines. It was the cash collateral that particular securities were invested in that really created the headache of 2008, 2009. So what we've seen and some of the regulation that has come out of that directly impacted cash collateral pools, but not only did it impact cash collateral pools, it also impacted our borrowers. So, 2008, prior to 2008, 2009, the U.S. market was predominantly cash collateral, and it was just the way the market worked. After 2008, 2009, and some of the capital requirements that came out of it, what we saw is that borrowers are less likely now, or not less likely, but they're pledging less cash to make sure that they meet their capital requirements that have been imposed to them by regulators. So, the reality of it is that the shift from cash is in two parts. It's regulatory, but also as our clients learned and they saw what some of the exposures of longer dated assets, they have looked for new ways to put more out on loan, but also meet the risk tolerance that they have within their program. So if we fast forward to where we are today, capital requirements, borrowers looking to pledge securities that don't impact their high quality liquid assets. So when we say high quality liquid assets, we're talking cash, we're talking US Treasuries. What they're looking to do is they're looking to pledge more securities from an equity or corporate bond perspective. And what's interesting about that is, predominantly, you look at from a U.S. perspective that we were predominantly cash. But once you step outside of the U.S. borders, it was a predominantly non-cash transaction. And those transactions weren't in the headlines that we saw 2008, 2009. So what our clients have found that, especially the ones that either got out of lending or were with one of our competitors and now are looking to get involved in the program with us, they're looking for ways to step into the arena and find ways that they can generate alpha, but also meet their risk tolerances. And so what we're really seeing is more customized programs. We're seeing ideas on which to generate additional alpha, but on more of a non-cash perspective. And the reality of it is as we've seen non-cash collateral balances grow, they're not impacting themselves. There's actually, for some of them, they're finding even more opportunity. What we've really found with our clients is as they become more flexible with their collateral schedules, they're truly able to benefit because borrowers are looking for alternative ways to be able to pledge securities. And that's really mainly in the U.S. equity and corporate bond space.
Got it. Okay. So those that are adapting are definitely thriving. Well, I've certainly learned a lot, and we've only just scratched the surface. Thanks for your perspective and insights, Kevin. And thank you for taking the time to listen. To get more insights and learn about our securities finance solutions, visit statestreet.com or get in touch. Thank you.